Hello and thank you for watching. This is Benjamin with LendSure Financial Services, and today I want to talk about renting versus buying and why Trulia says it's 38% cheaper to buy than it is to rent. As you consider whether to rent or to buy, it's good to look at the pros and cons in your personal situation for renting or buying. Let's look at the renting pros and cons first. On the pros, short-term flexibility, no repair or maintenance costs, simple and short contracts, and you'll have less responsibility as a renter. The cons of renting, no fixed rent price. Rents do go up. You have no control if the landlord needs to sell the home down the road. You won't earn equity or appreciation or any tax breaks, and you'll have no personalization of the property. Let's move to the pros and cons of buying now. On the pros, you will have a fixed payment that won't change. It's a long-term location for you. You'll have equity appreciation, earn long-term wealth, pay less taxes, and have ownership rights as the owner. The cons of buying, you will need some cash and good credit for a purchase loan, which I can help you with. It is a longer-term commitment, and you will be responsible for the repair and maintenance costs. So which profile fits you best? Hopefully, if you're listening to this video, you're looking more towards buying than renting at this point, and there's some compelling reasons why. We're going to specifically look at these three pros of buying: equity appreciation, long-term wealth, and you'll pay less taxes. Let's look at those more specifically, starting with equity appreciation. When you pay rent to your landlord, you will never see that money again. The landlord's either going to take your rent money and pay the mortgage or pay himself. You will have no ability to have that money back. Why not purchase a home and see your payment come back to you in the form of equity appreciation? Let me show you with an example. Let's say you are currently renting a home that's worth $400,000 and your rent payment is $2,300 a month, and the owner comes to you and says they'd like to sell the home. You come to me and get pre-approved, and we figure out you can do a down payment of 5%, an interest rate of 4.5%, we give you a loan amount of $380, and a total payment of $2,531 a month. That includes your property taxes, insurance, and mortgage insurance. That's only $230 more than what you were paying in rent. And look at all the upside you get. We'll take your loan application to the bank and get it approved. And you will agree to pay a principal and interest payment to the bank for the rest of the life of the loan. And that payment will be $1,925 a month. Every single payment you make, some of that will go back to you in the form of paying down the loan, which will create equity. When you pay the principal, you're creating equity for yourself. Let's look at the details. On your very first payment, of that $1,925 payment, $500 of that will go to paying down the loan and will create equity for you. At the 3-year mark, that principal payment is increased by $70. You're paying $70 less in interest. So as the loan gets older, you are paying more to yourself and less to the bank. And that's a really good thing. You're essentially building equity with every single payment you make. And it just gets better as the loan matures. Let's look how it looks at year 5. A little bit higher on principal, again, less in interest. At year 10, even better. And at year 30, almost all of your payment goes to paying you back in the form of principal buy down, and only less than $5 goes to pay the lender in interest. And the whole time, your payment stays the same at $1,925. You're always paying a little bit more to yourself and a little bit less to the bank when you have equity appreciation. Let's move to the next principle. Long-term wealth. Most retirees will tell you that their retirement was based on their real estate investments, and that's because home prices go up or they appreciate. Here's a chart showing the 30-year history of home values in San Diego. And as you can see, from the very beginning to the chart until current day, it's a nice upward trend. Now, some people will say, yeah, but look at the last 10 years where home prices fell dramatically. And that is true. It is an up and down scale. However, even looking at this chart, you can see from beginning to end, it's still a slight upward trend. Now, if you were able to purchase in the last 5 years, you are extremely happy with the amount of appreciation, and that's the power of real estate. You have the ability to create long-term wealth when the home appreciates. Last principle, you get to pay less taxes. The IRS allows you to write off your mortgage interest, property taxes, and mortgage insurance depending on your income. It's right here on your Schedule A in your tax returns. Taxes, interest, and mortgage insurance will not be taxed, and therefore you are paying less taxes than if you were renting. Another cool item is capital gains exclusion. What that means is when you sell the home, you will pay no taxes on the profit you make. That is a huge bonus, and most asset classes cannot say that that's the case. So for all of these reasons, that's why Trulia, a real estate company, has put together an interactive map that says that it's 38% cheaper to buy. I strongly recommend finding this article and playing with the map, which allows you to adjust the rate, your tax bracket, and how long you'll own the home. It'll give you very specific numbers regarding your geographical area and how much cheaper it is to buy than it is to rent. If you want to get started, all I need from you are two important things: your monthly budget and how much down payment you have available to you. Call me to get started or to refer a friend. I look forward to working with you soon. Thanks.